All right, we got about 2 minutes before we're gonna go live. Sorry that stream timer went away for a sec here, but we're gonna be getting going shortly once we get a few more people in here. Sierra, how's it going? Welcome to the chat. We are 1 minute away from getting going. And my neighbors are incredibly noisy right now, so if you hear any noise in the background, that is probably what you're picking up. Jules, welcome as well. We've got the whole gang. I will take a look at random chat. Here we go. That is the end of the timer. I will take a look at random chat really quickly, see what's going on. Once again, my computer's super slow. But anyways, that's the end of the timer. We are finally going to get started with this. And I assume you're talking about the asparagus that are enormous. Those are some big asparagus. Let me zoom in on this really quickly because this is probably really small on you guys' screens. But real quickly, what we're going to want to do this week, probably the same thing that we do most weeks where we recap and then discuss some stocks. But I do want to make things a little bit different. I feel that as far as how we break this up, typically we spend a lot of time on doing the recaps. And for those of you that follow us, we play relatively similar plays on a week-to-week basis. And I feel like we've started to get to the point where, it might get a little bit repetitive if I'm saying, oh, I've got all this in my recap and then just talk about those for the next week. So what we're going to do is we're going to quickly recap what we did last week, and then we're going to jump directly into Thinkorswim, start pulling up some scans, coming up with some new unique trade ideas aside from what we have in here for those of you who are looking for new positions. Obviously, if we still have some of this open, we think it's a good position to be in, but that should kind of be implied. So I think it'd be a lot more useful if we went through some scans live on the stream tonight. Tried out some new trade strategies and ideas that we've been throwing around in the chat this week, and getting into more of that instead of the typical 30-minute recap and 30-minute taking a look at random stocks. So we're going to try to discover some good opportunities with our scanner. But to kick things off, we will do the recap really quickly. UWMC was super good to us. We picked up 2,000 more shares last week when it was at 680 because we thought, for those of you that have been following us, we always say that UWMC is this awesome value, and we've been saying that since it was at 10. And yes, good question from Sierra. We're going to be looking at the ones that Jeff A posted. A lot of that stuff that's been coming through that Trade Intel channel in our Discord server, I think, has been super helpful and super interesting. So we're definitely going to take a peek at some of those tonight as opposed to, what we typically do. So anyways, UWMC, we thought that was a great value. All in all, we picked up about 3,400 on that one, it looks like. PSTH, this is wrong. We cut this one off, so this is a zero effect for the week. LOTZ, we jumped out most of it before earnings. So we still took a pretty big loss, but this thing's trading around $5. And because of that, we rolled down into these 521 5-strike puts, and we're sitting on those for next week. Hopefully those will expire worthless and we could, rid ourselves of this stock for the time being. ICLN, another super, super, super boring play. STON unfortunately dropped a little bit on us, but that one's going to wrap up. If we pop over to our trade breakout tab on STON, we've got a break-even price of 194. So as long as it stays above that, we can consider ourselves winners on that one. Even though at one point last week it was up near 250, sometimes stocks go up, they go down. We were in a position where we were going to cut this trade completely loose at one point because it went down so much, and the fact that we can make any money at all is something I'm perfectly fine with, so not going to complain too much about that one. RMO, we had to cut ties with our 9-strike puts. We're still holding on to the shares. And you might say, okay, why were we cutting ties with this? Did we not like the play? The answer is that we did like the play, but we got into the position with Etsy and Zillow kind of moving against us this week, where we unfortunately had to close some of these positions just to preserve buying power. So that's something we also want to be a little bit more careful with. We always say that we're going to try to conserve as much buying power as we can, and then I get a little bit trigger happy when the market opens and I'm sitting behind the broker screen. But we could always, it's always good to reflect on areas we can improve, and that is definitely one where I can improve a little bit. We talked a little bit about these Etsy, Twitter, and Zillow. Those were our big plays for this upcoming week, our big safer plays where we use some of that margin to get a little bit of leverage on that to create some nicer returns. Etsy, objectively, we made money on this, but we picked up $2,400, so not too bad. But when compared to what happened with Etsy, the week before where we lost 5,100, we're still in the hole a little bit on that one. Popping over to that trade breakout tab, where is it? As you can see, we opened up 160 puts for this upcoming week. We sold 7 of those, and that'll get us to a position where if Etsy finishes above 160, we're only going to have lost $339 on the trade, which is, something I'm perfectly fine with considering the stock has dropped 20% on us. So we're trying to be as conservative as possible with these strikes that we sell. We rolled everything down from 120 and 165 to this 160 number, and I'll happily roll lower in the future. And we can maybe pull a profit, not next week, but in the upcoming weeks out of this trade. Flipping back to the main tab, Zillow was one. We picked up profit on both of these individual legs. There was a point this week where Zillow was above 115, so we were hoping we'd squeeze max profit out of those, but unfortunately no dice. That's just the way the game goes sometimes, but we love the game because Zillow went down and we were still able to pull out $1,000 between those positions. Looking at what we've got lined up for next week, we rolled all of these down. If this will load for me, I can tell you what we did. We rolled them down to 105. There we go. We rolled these down. We rolled the 115s down to 110, and we opened some additional 105 strike puts because I'm really into the idea of selling super, super conservative strikes these upcoming weeks because I am a little bit wary. We talked about it last week. I think the market is getting to a little bit of a tipping point where we could see some sort of a pullback soon. And we did see a little bit of that last week before a nice recovery on Thursday and Friday, but the market still went down over 1%, which is a decent move downwards for 1 week's time. But with that said, we think 105 is a great strike to be selling those Zillow puts at, so we went in a little bit heavier in that regard. And again, we're at a position where we started Zillow. It was trading at 130.50. Our initial break-even price was 116.75. But in 2 short weeks between April 30th and May 14th, we went from the price of the stock being at 130.50 to now having a break-even price of $106.57. So we are perfectly happy with that one, even though the stock's gone down 15% on us. But hey, that's just all part of the game. We love these conservative strikes, and we're going to talk a little bit more about doing something like this in upcoming weeks later in the stream, because that's something I think we're going to begin to lean pretty heavily on as we move into a period of a little bit greater uncertainty in the market. And then rounding things out, our SPX hedge worked out great. We got out of JMIA just to conserve some money and conserve some buying power because we got a little bit worried about the market dipping. So we got out of that one with a small profit. I'm not sure what it actually finished the week at. We could take a look really quickly here. Yeah, it finished the week at $25.98. So these actually would have been worth, 2 cents a pop? So we would have made another $1,000 if we held on to those. But hey, that's how the game happened so far. And exactly, we got that comment from Quantic. Nice recovery thanks to the bird. And Sierra, if a bird ever poops on any of your children again, please let us know, because that could be the greatest technical indicator of all time for us. That was a great Friday that we had, especially coming off a Thursday where we were up a bunch at the beginning of the day and then ended the day with a decent loss. Always super nice to finish off Friday with a really, really big gain objectively, and one that got us back to a position where even though all these positions that we had were moving against us and the market dropped to 1.31%, we were still able to outperform by 0.34%. So that's something that we think is, awesome, and just, again, a testament to the strategy that we're running, the fact that these could all be moving against us, yet we're still outperforming. And we would have been outperforming more if we weren't so leveraged. As you could see, usually when the market goes up, we outperform more because of that type of leverage. When the market is flat, we go up a lot more. That was a monster week. But the market goes up, we go up slightly more. That's kind of the idea of how our performance against the S&P 500 looks. And I could probably better illustrate that by going to our year-to-date summary chart. Now, the weeks that it goes up, we go up a ton. And the weeks that it goes down, we go down a decent bit. And this was a really bad week for us on May 2nd. That was highlighted by the Zillow and the Etsy losses. But that's okay. We're going to try to work our way back. Our goal right now, flipping back to this tab, is just to get back to break-even price for May, if we can do that, and that'd be $16,000 of profit over the next 3 weeks. Something I think is doable with what we're sitting on, but it's important. There's no such thing as a shortcut in the market, so we're not going to try to get it all back in 1 week. But we're in a great position this year that's afforded us, some flexibility. If we're flat for the next month or two, that's okay. You're not always going to be making money week to week or even month to month. I think what we had done through April was really awesome. I had some pretty bad luck for stocks that moved against us, and we were still able to pull this kind of a return. So objectively, from where we started to where we are right now, we're super happy. Obviously, it sucks to lose as much as we did so far in the month of May, but that is part of the game. Anyone who tells you otherwise is not giving you advice that is within your best interests, because stuff like this is going to happen. The important thing is that we're, one, not blowing up our accounts when stocks move against us, and two, putting ourselves in positions where we can recover and eventually scrape out some profit on these individual positions. We talked about that a little bit with Zillow, where we could still make a nice profit. We talked about it with Etsy, where we can get back to just about break even. And then Twitter is that other one that we had as part of this big 3 plays, and we could pop open that trade breakout tab as well. We rolled these down. We've gone week by week by week. We've rolled them down one at a time just to try to get us in a position where we're going to at least break even, because this thing's dropped 9.26% on us. And I promise you the game's a lot easier when stocks don't move so sharply against you right off the bat. But either way, to further illustrate how useful what we're doing here is, we started on April 30th, another one that we started April 30th, where the stock was trading at $57.01. And our break-even price as of last Friday is now $52.58, which represents a 7.77, lucky number right there, percent reduction in our break-even price, which for a stock of this size is really, really solid. If this thing pops back up to 53, we're going to scrape up a nice $420 gain, which is still, based on the capital that we have invested, a 3.8% return despite a 7% decrease in the stock. Probably boring you guys to death with these numbers, but I'm sure you guys get the program at this point. We're just getting more and more conservative. We could have kept these up at 55, I guess, if we want to talk about other potential ways that we could have handled this trade. However, I really am a little bit worried about where the market's going. So we're going to try to be as conservative as possible, and that kind of rounds it out. CLOV, we also had to close this one out. UXIN, we're going to collect 300 more bucks on that one this week, just assuming the stock stays above $1. And it's, let me pop over to that tab really quickly as well. It's at 273, so I think we've got some pretty good odds on collecting the remainder of that trade. So that is our recap. I tried to make it as quick as possible. I think we got through that in about 15 minutes, but enough about that. I mean, what we've got lined up for next week, I haven't cleaned this up yet and figured it out, but what we've closed out is LOTZ, but we're sitting on the 5 instead of the 7.5. We're out of CLOV. We're out of RMO for the most part. Still have the shares. And then we're letting pretty much everything else that we have in here play out. We rolled Etsy down. We rolled Twitter down. We rolled Zillow down. So we're sticking with those main plays, and I like the way that they look for the upcoming week. But, we talk about these so much in our Discord server, so I think talking about them any further tonight would be a little bit of overkill, to be honest. So we're gonna try to get some new names in the mix, run some scans, see what we could do, and pull up some new names. Thinkorswim right now on a screen on my other phone. Give me 1 second for it to sign in, and I'll drag it over. Before we All right, we are signing in. Probably should be doing a little bit better killing the dead air that we've got right here as I wait on this. But yeah, definitely excited. Take a look actually at our Discord server right now to kind of show you guys what I'm talking about here. Before we get into this, let's pop it open. Thinkorswim is still loading, as is Discord. Wow, I wish everything was a little bit quicker. But what we got is what we got. Let's keep it moving. Please load. As we now sit here at the mercy of the speed of my computer. All right, great news. Thinkorswim is open, so we're gonna the Discord's open now too. I guess that must have been what was holding it up. So if we could pop over into the Trade Intel channel really quick to give you guys a run through of kind of what I had in mind that I wanted to talk about tonight on the stream. So if we take it from the top, I was kind of rambling in here a little bit at some point earlier this week, and I thought I was onto something a little bit. But yeah, we want to scan for stocks. This is perfect within the context of our strategy. And this is also probably super, super small on your screen, so I apologize for that. But the idea is that we're going to be scanning in the first part of our stream here for stocks that have what's called volatility skew. And what that means is that the calls offer more premium at a similar strike out of the money than the puts. Update on the laptop right now is probably a great time to update you guys on that, as my backup one is shitting the bed live on stream. But I've sent it in. I literally have not heard back from them, so I'm probably going to try to follow up on that. And then hopefully at some point this saga of my terrible laptop that kind of just completely quit on me, and the manufacturer has been dancing around giving me a replacement. Hopefully that will finally come to an end, and we no longer have to rely on the poor processing power of the backup laptop here. However, back to the main point, what we were going to get into first here. It's called volatility skew. And what I first found was this website called optionistics.com, something like that. So we popped this one open. And what I first found was that, hey, you first need to sign in and like pay for a premium account if you wanted to get going on this. I could make this a little bit bigger, so hopefully you guys can read it. If there's any feedback on the text size from the viewers, feel free to let me know and I could make adjustments. The monitor I'm working on right now is pretty big, so it's definitely easy for me to think that something's readable but might not be readable on your side, so feel free to let me know if I need to make anything bigger. But the idea here is that this scanner scans for stocks where call premium is higher than put premium. So that does two things for us. The first is that it makes it more advantageous for us to sell covered calls, because synthetically, and let me drag Thinkorswim over here to kind of illustrate this point. Here we go. And we are rocking and rolling. So if we pull up a random stock, I think Apple's probably a good example because it's a really basic liquid stock. So perfect. It was trading at 127.45, so kind of right in the middle of 127 and 128. It's a little bit closer to 127, so those might have a little bit more premium, but you'll see this is roughly 50 cents out of the money. It's 45 cents out of the money and has about $1.50 of premium. This is 55 cents out of the money and has $1.40 of premium. So that's relatively similar. And again, if you step up, you're going to lose 30 cents. You step down, you're going to lose about 40 cents, it looks like. But the idea is that if you go, $3 out of the money here and $3 out of the money on the put side, you're going to see relatively similar premiums. However, in the instance of a call skew, you're going to see premiums over here are going to be way higher than put premiums at similar strikes that are, similar distances out of the money. So again, that does two things. The first that I mentioned is that it makes selling covered calls more advantageous than cash secured puts. With our HT wheel strategy, we love to get in with cash secured puts because, 90% of the time, 90+% of the time, really, that's going to be the safest, most advantageous way to begin a trade. However, when we find these rare instances of call skew, a covered call is going to be a better way to get the play started off. So that's the first advantage that this provides us with, is we could jump right into covered calls. The second advantage is that, higher call premiums suggest that there's upward pressure on the stock. So not only do you have the first point, which is you have more option premium working for you on the call side, but that premium is there because the market is telling you it's more likely that the stock goes up. And since these strategies that we're running, covered calls, are bullish, that also puts the price direction on our side. So we've set up a covered call where we're, one, getting more premium, and two, getting more premium because, there's this implication that there's this upward pressure, and that's why there's greater premium on the call side, if that makes sense. If anyone has questions on that and I was just rambling and that didn't make sense, feel free to let me know. But really, it's like a win-win situation because you win by getting more premium and you win by opening a play on a stock that presumably will be going up in the short term. So a lot of that is a little bit theoretical on my end, so I wanted to test it out. So what this says is this data is delayed from April 23rd, 2021. And I'm not positive the way they got this laid out, but I think, top to bottom, this is like the highest call skew at that time, which was April 23rd. So to test out what we were talking about here, we'd want to take the first stock, SPI, and take a look at what it did on April 23rd. So let's pop the chart open. Hopefully, there we go, loading a little bit quicker today. So let's take a look at what happened on April 23rd. Here is April 23rd. That week, the stock went from 636 all the way up past $7. And we would have been out of the trade by then if we had an expiry at the end of April. So the point here, and, checking these stocks against their charts and the date that we have right here, is a way of verifying this thesis that we have. So we see from April 23rd, you would have got in at 650, maybe sold a 7-strike call. But by expiry, it got up to where it needed to be, which implies that stocks with high call skew imply upward movement. We could keep doing this, right? With ACAD even, let's check that one around April 23rd. April 23rd, this one dropped off a bit before earnings. So that goes a little bit against our theory, but at the same time, the way these strategies work, if we just kept playing it, it popped right back up and is now above where it was trading on April 23rd. So this one would have become a winner. We could keep going down the list a little bit. MNKD, I think that one's a, pharmaceutical one, so this might not be the best example. But yeah, April 23rd, it was trading at about, it looks like 460 is where it got here, and then got up to about $5. But again, not the greatest example here because this is a pharmaceutical company and there's a pretty big sell-off. SOLO, I believe that one is not a pharmaceutical company. So we'll take a look at that one really quickly. If we look at April 23rd here when the chart pulls up, correction, if the chart pulls up, it was doing so well. Well, this seems to go a little bit against the theory. But as you can see, in the short term, there was a slight rise in price over the next few days, despite the fact it did sell off pretty hard. So, maybe not as great of an idea. And when I checked this last week, I think the first 6 on there all behaved in the way that we would think. So I think it would take a little bit more analysis on our side about, maybe pulling down all of this data right here and then checking it against the price move in between, April 23rd and April 30th. Because all we really need here is confirmation above 50%, right? So if we could find that, maybe not every single play is going to pop off just because there's some skew as far as premiums concerned on the call side. But if we can get greater than 50% success rate on this theory, I think that's enough to start working with. And since we did mention when we first jumped onto this site that you can't really get up-to-date data unless you sign up for a premium subscription, what we found was another one right here on fdscanner.com that does exactly what we were looking for. It talks about, what skew index is. It talks about potential causes, for example, unusual and extreme speculation of stocks, stocks with limited downside but very high upside, we absolutely love that. Because for starters, if we get in on a stock with limited downside, the high upside creates good premium. And as we know how our adjusted basis works, we'll be able to drive down our adjusted basis on a stock with, presumably limited downside in the first place, which puts us in a very, low risk, high reward situation. So let's take a look at what they've got on the list here. They plot everything out, and I think, you could go over the dots, but the easiest way to read this, and these are some very, very high numbers, but they've got the ticker here. They've got the call skew here. Anything I think above 1 indicates that calls are more expensive than puts. And let's just go down the list right here and take a look at a few of these. STX, Seagate Technology, and what's super helpful from what they've put out here is the sector that they're talking about, because we do want to try to avoid healthcare in general with our strategy. And while there are some awesome premiums in healthcare across the board, and you might say, oh, this is a great thing to sell an option on, the fact of the matter is, in my opinion at least, and feel free to do as you please if you understand the way the strategy works, but I think in the context of our strategy, the experiences I've had and the experiences I've seen others in our Discord server have, healthcare I think is just way too news and results based for what we're trying to do, because we could protect our downside to an extent, right? If a stock's dropping 3% week after week after week, that sucks, but with the amount of premium we collect, we should be able to handle it. If a stock fails a trial and drops 60% overnight, we're kind of shit out of luck and there's not much we could do. So that's why we try to stay away from healthcare, because those companies kind of lend themselves to being stocks that potentially could fall by 50% overnight. So that's why we avoid those. And while there is that huge upside where you could get 200, 300, 400% if, one of their drugs successfully completes trials, the way to play that is not through option selling. Feel free to, if you have some huge conviction about a stock or something, just load up on shares. No need to cap your upside by selling covered calls. Maybe buy some in the money calls to get some leverage on the cash that you're throwing into that position with unlimited upside. I think that's really the one industry where I don't think buying options is a bad idea. But as far as what we're doing, I would not recommend selling. But I digress. Let's get back to the point at hand. STX, Seagate Technology. Let's take a peek at what that's looking like. All right. And I can tell you exactly why there's so much call premium. It's because it's run up a ton last Friday. But premium, if we take a look at the options chain, suggests that it might run up a little bit more, right? So what we'll see here, and we could illustrate how this call skew works, right? So it closed at about 98 bucks. So if we go $6 out of the money, it'll take us down to $92. So a put that's $6 out of the money is trading for, what's probably a midpoint of about 40 cents here. And we could even take a look at the last trade that went across. Maybe the mid might be easier. I don't even know if I can get the mid in there. Let's see the volume, if there's even any volume on these in the first place. I mean, yeah, decent enough volume to execute a trade for sure. But what you'll see is generally these are about 40 cents for something that's $6 out of the money on the put side. So if we go to the call side and go $6 out of the money, that's going to put us at 104 here. And it's trading for, between $1 and $1.43. So we'll call it about $1.20 of premium, which is almost 3 times as much as what we're seeing right here. And that is what call skew is. So whether or not this is one I would want to get in on, I think probably not, because we don't really like setups like this. We could back the chart up a little bit more and get a little bit more context about what's going on here. I'm not even entirely sure what they are. If we go fundamentals here, go STS. They're electronic data storage and technology. I have no idea what we could, again, check the live news and that'll maybe tell us. Yeah, so their shares take off because crypto farmers are buying up all of their hardware. So that's something where it might be a little bit too speculative for what we're trying to do, but Again, it was at the top of that scan and a great illustration of what exactly call skew is. So this might be one that's fun to just to, keep an eye on in the next week. There's no need to play every stock that we see and come across. I think that's not necessarily the best way to go about this, backing up again to the 10-day chart. But RSI, which is one of our favorite indicators, is way, way, way overbought. So just not a great entry, despite the fact we have this call skew working in there. So let's go back to the scan. We're going to skip REGN because that's a healthcare stock. We're going to pop down to WDC, Western Digital, tech company trading at $71 a share. Let's go pull up the chart. Oops, WDC. And again, almost identical to STX. Look at these two charts. These look so similar. That was it. And let's check the news on this one. What's going on with this? Well, I probably should have just read the entire headline the first time because the headline says Seagate and Western Digital shares take off. So I guess they do the exact same thing. That's why their charts look very similar. And they have this call skew that is almost identical to what we saw before. So due to the nature of that, we're probably going to sit that one out. We've got FANG next up on the list, Diamondback Energy. Let's take a peek at what we can see. And this one is a lot better looking as far as entry point and what we're trying to do when we're entering positions like this. And just to further get in on what I was kind of saying by that is looking at this 10-day chart here. We can even back up to the 20-day to see what it's been doing over the past month. Traded between 72 and 87, which obviously is a decently wide range. Let's back up to the 180 again. Yeah, and these kind of scare me a bit. But it has held this range for a decent amount of time, 2 or 3 months. So nothing as volatile as something that shoots up and then inevitably is going to come back down. So it may have found some new support up in this level. Not a terrible entry again when we look at the month chart. And the best part of it all is it has this call skew that we've been talking about. Again, closed at 78.70. Let's go $7 out of the money on the upside. We can get 60 cents. $7 out of the money on the downside, we can only get 20 cents. So these calls are offering about 3 times more premium. There's a lot of volume on the call side, which compared to the put side, which indicates there's some serious demand for the calls as opposed to the puts, which again would potentially suggest some sort of upward buying pressure on the stock. RSI dead in the middle, 54, indicating neither overbought nor oversold. And this one isn't too bad of an idea. I don't really have this, burning desire to be getting into the energy space right now, because I think a lot of that is starting to get a bit overvalued. But at the same time, if you could jump in here for a weekly, because again, these expire in 1 week, 80 strike call, $1.80, that would knock your basis down to, $77. And you'd be sitting with this basis for the next week with potential upside to $80 a share, which isn't a huge return, but it is what it is. The premium isn't that high. We can go back to the scanner and take a look at a couple more on here. DXC. Let's actually look in the share price column, see if we could find anything a little bit cheaper, because I think the cheaper stocks lend themselves to being more universal plays. And there we go. We've got one right here, Macy's, with the ticker M. There's some call skew on that one, so let's pull up that chart. And that is a very similar shape to the first couple that we looked at, where it is just completely shot up. Again, they've got weekly expiry on the options. However, the call skew doesn't look as exaggerated here as it did on some of the other ones that we were looking at. So this might be one that, especially since this isn't the greatest entry point of all time, and if we back up to the 180-day chart, yeah, it's a little bit overextended, I would say. RSI just shot up to 66. So maybe if it settles back down in this range, it might be a decent idea to get in on. But again, Macy's was one of those retailers that was having some cash flow issues during the COVID outbreak. So I'm still not entirely sure what the position of their business is right now. So can't speak too much to that, but just taking a look at these, and it honestly looks like there's more premium on the downside. That's just because 18 is closer to the current price of 18.08 than 18.5. So that makes sense. But, we could look at these options really quickly. Return on risk. These are giving you 2% per. And we could maybe get into this discussion of return on capital when we use a little bit of leverage. But I don't think Macy's is one that would allow you to use leverage. For example, this is a 15 strike. So normally if you wanted to sell one of these, it would take $1,500 in collateral. So if we pop to one of these, it's going to require, you can see by buying power effect, only 150 bucks. So you actually can use these looser buying power requirements on this kind of a stock. So that's very interesting because, we see that a 15 strike put, and this might be jumping ahead a bit to the discussion that I was going to get into a little bit later in the stream, but this idea of using leverage on safer stocks. Now, I don't know if this necessarily would be thrown into the category of safer stocks, but you point to the fact that it's traded above, 14 bucks for the better part of 2021, and there's a decent base around 1560 right here. So, you might consider it to be safe in that regard, but let's talk a little bit about what leverage can get for you. And we see ROR here expressed as a percentage, and that's the percentage return that the option premium represents if you were selling that thing completely cash secured. And we could drag the calculator over here to demonstrate what we're talking about, right? So if we sold a 16 strike put and we got, let's say, 27 cents of premium, we'll call it 27, you know that you're going to get a $27 return, again, because that 27 cents of premium is multiplied by 100, since each options contract is worth 100 shares. And then it's going to be divided by 1,600, because that's the amount that it would take to fully cash secure that. And you're going to get a 1.68% return because you're, locking up $1,600 of capital to make 27. And you can see that expressed right here with the ROR. And you might say, okay, 1.68%, objectively, if you're going to get 1.68% per week for an entire year, you're going to be killing it. But, the question arises, this isn't that great potentially for the risk. Maybe this isn't exactly what I want to do. I think this is a lot of money to lock up to make this much. And, that might be that's not an invalid thought to have. I would be the first to tell you that, hey, 1.68% a week isn't too bad. But let's talk a little bit about using buying power and, leverage and margin as far as collateral you're putting up for this trade. So we know that if we sold this fully cash secured, we need to put up $1,600. Now, if you wanted to sell one of these 16 strike puts using these privileges, and the amount of collateral is going to be expressed by the buying power effect, because that is the amount of money that TD Ameritrade is going to lock up. So that's your new collateral number. We know before at fully cash secured, it was 1,600 bucks. Now, if we wanted to sell one of these at a 16 strike and get 26 cents, our buying power effect is only 160 bucks. So instead of having $1,600 of collateral, we're only going to need 160 of collateral for the same $26 in profit, right? So if we get $26 of profit divided by 160 in collateral, that's a 16.25% return, and our numbers are slightly off from what they're using to calculate here, but as you can see in the ROC column, they've got 16.56%. And a 16.56% return every week is incredibly good. If you went 1.16 times 1.16 in 1, 2, 3, 4, 5 weeks, you would double your money if you got a 16% return every single week. And that, again, that's at the 16 strike. We could pop back over to the chart to let you know where that is, and that's at this right here. So for the next 5 days, as long as it stays above this level, and we could zoom in a little bit better to give you some more context, but as long as it stays above this level for the next 5 days, you could put yourself in a position where you pull a 16% return in a week. And as we know, we got 26 cents of premium, so your break even is down here, a point that's pretty much lower than any price that it's traded at in the past calendar month. So that is the power of using this relaxed buying power requirements that are granted to you by margin to take something that normally would have been a 1.68%, might have been kind of boring play, and turning it into a 16.56% return on the week. And you could use this leverage as much as you'd like, right? If you want to sell one for 5 cents down here, a 0.42% return is kind of boring. But if you wanted to use that leverage, you can now get a 4.17% return, which is phenomenal on a week-to-week basis. What strike was that we were looking at? We were looking at a 12 strike. Let's zoom out. We have to zoom so far out on the y-axis here to get down to 12. Going back to the 180 day, 12 is right here, and it hasn't traded below 12 since January 22nd is when it got down to 12. I don't even know if it got below then. January 6th is when it first broke above 12. And at that point, unless something super, super crazy happened with this stock, you wouldn't see a sharp dive down to 12. It'd be a low grind, and you could adjust the put strikes that you sell accordingly on a week-to-week basis. But honestly, as far as trade ideas are concerned, especially if you were looking to use a little bit of leverage to take what should be a safer play and squeeze out a little bit greater of a return, this is actually a pretty good option to do that with. So even though this was on the list of stocks that have a little bit of call skew, selling these puts might not be a bad idea because of this increased return on capital percentage that these puts are offering thanks to relaxed buying power requirements. So, I mean, I might keep a little bit of a running list over here on the profit tracker of, stocks that we've taken a look at from the stream. We'll call it, I don't know, watch list. I'll put M on there. But the great part about this is, it is a little bit of a double-edged sword, and we're always so careful to talk about risk that you're taking on in a trade. So let me actually demonstrate what would happen if shit hit the fan, because I think that's incredibly important to be aware of, right? So let's take Macy's, for example, and let's say we sold the 16 strike puts. We're going to sell 10 of these, for our example, for 26 cents a piece. And great question from KB in the YouTube chat. Would you be paying interest in that example if you were using leverage on the Macy's trade? And here is the best part about using leverage when you're selling cash secured puts. You pay 0 interest. And why is that? The answer is because you're not borrowing any money from the broker. If you wanted to use margin to purchase shares, you have to pay someone money to get those shares, and you wouldn't have that money. So you borrow the money from the broker to give to someone to get those shares. So you're paying interest on money borrowed from the broker. But let's think about the actual exchange of cash when we're selling puts. We're not buying anything. In fact, when we sell 10 of these, someone's giving us $260 off the bat. So all the broker's going to do is tie up a little bit of our cash as collateral. What they're not going to do is charge us any interest, because there's nothing for them to charge us interest on because we haven't borrowed any money. From a cash flow perspective, our account actually has $260 more in it than when we started. So that's another reason why selling cash secured puts using some of this leverage, I think, is so advantageous, because one, like we talked about, you're able to turn some of these smaller RORs into really big ROCs, which is all you should be worried about on a week-to-week basis for your account. And two, because you don't have to pay any margin interest on any of these trades. And I don't know if I could bring it up here, but on the app that I have on my phone, it shows, margin balance subject to interest. And we're using this for Zillow, Twitter, and Etsy right now. And we have $0 that are subject to margin interest. So it's a great way to get that leverage and use that relaxed buying power privilege that TD Ameritrade grants you, and other brokers will grant as well, without having to pay any of those margin fees that are associated with that typically if you were one who were going to be buying shares. Hopefully that explanation made sense for you. But moving forward, because what we think is always so important to talk about is the downside risk on trades like this. So let's say we sold 10 Macy's, and we could throw this in here, right? Ticker is going to be M. I really wish I had this updating. Google Finance, boom, pull that in. And we're going to say what it started at 1808. That's not really relevant for this trade, but we'll say we sold 10 Macy's 521 16 strike puts, and we got 26 cents for them hypothetically. So let me update this formula as well to 16. What we know is if we open this on, well, say we did it tomorrow, 5/17, it expires 5/21, little 5-day trade. This is irrelevant right here. But the amount of collateral is the buying power effect of $1,600 right here. So we throw $1,600 as our collateral. And what we would see again is that 16.25% return on capital figure that we see highlighted in the row right here. Hopefully you guys are following that part of it as well, because we're getting a $260 profit on $1,600 of collateral, which is phenomenal, to be honest. So sticking with that, and let me double check that they don't have like earnings or anything. Macy's has earnings this week. Well, there you go. That is the reason for this incredible premium. However, that might discourage me from this trade, but the principles that we've put forth here about how to use this leverage in situations you could put yourself in with this, I think are still entirely applicable to what we're doing, regardless of if a stock has earnings or not. But moving forward with what could potentially happen, let's say that we did this for earnings, because earnings are one of the best times to be selling options, because there's always hyped up and juiced up premiums, because there's typically pretty big implied moves. So if Macy's went down to 16, we're going to play the what if game here. We know that we still would be at max profit, right? If Macy's went down to 15.74, we'd be breaking even, because that would be worth 26 cents at expiration, the difference between the stock price and the strike price. However, when we start to get into a little bit of hot water is if things really start tanking on us. So if we go down to 15.5, we've lost $240, which objectively is a 15% loss on our capital. But again, that's a 15% decrease in the stock that you would need to even get there in the first place. It's much more likely that you're going to be getting this 16% return. But let's say it keeps dropping. Let's say it goes down to 15. You've now lost 46%. Let's say it goes down to 14. You're now in a position where you've lost more than the collateral that you initially put up. And again, that is something that would only happen if it went down 22.5%, which objectively for a stock that's had this kind of action is unlikely. I definitely don't think it's likely that we see 14 on here anytime soon or something like that. But that may also be a reason why you want to get more conservative and move down to what's only potentially a 10% return on capital, but a lot bigger of a cushion at a 15 strike. But again, we say this every week. That's kind of the game that we play, picking the strike versus the return. How aggressive do you want to or not want to get? That part is all up to you, as long as you are selling options that have a big chunk of extrinsic value. You're playing the right game. And then, any sort of gaming the market that you want to do by picking the trade-off between the strike and the return is fully up to you. But point being, this thing's at 18. It would have to go all the way down to 14, which is a 22.5% decrease. But then that is the point where you find a trade where you have now lost over 100%. And this is where you could really get in trouble. I mean, if this thing, they have a terrible, terrible earnings and drop down to 12, which is a 33% drop, you've now lost 233%. So that is something that is super, super, super important to keep in mind, because while obviously the way the numbers work, it's not going to happen very often, if at all. It's just something you need to be aware of and need to be prepared for, because if it does happen and you've got these positions, you need to have a backup plan. Well, that's why I think it's really important for us not to throw all of our cash into one of these positions at a time, because if one goes down like this much in 1 week, which again, completely unlikely, but if it happens, we want to have some cash on the side to either manage that play, pull it out, or have enough, or have a small enough of a position in the first place where a huge drop like that doesn't really affect us. But again, more likely than not, Macy's isn't going to go down 11.5% in 1 week. Again, one of the more helpful tools on the Analyze tab is the Earnings tab. We can type in M for Macy's. We have a drop from 19 to 16. We have, 15 to 12? That looks like a pretty big drop. But nothing else. I think Q2 19 and Q4 19 were the two biggest drops. And we have a, $2.50 per share drop right here. And then a, $3 per share drop right here. So if over the last 8 quarters they have as bad of a drop as they've had and the thing drops $3 and you're at 15.08, yeah, you've lost 41% on it. But, in the face of a 16.59% drop, things could have been better. Or excuse me, things could have been worse. And, money-wise, you've got a $660 loss. Let's say next week you just set something similar up. You get $260 of it back at a time, and the odds will work themselves out. we are putting ourselves in positions that have positive expected value by doing this. And it's one of those things where by having the numbers on our side in the long run, as we have demonstrated with the trades that we've thrown out there, more likely than not, you're going to be trending upwards as long as you're not playing some super crazy, stocks out there, which we are definitely guilty of sometimes, and why we have some pretty steep drops in our account balance throughout the year. But in general, the trend is upwards. We could go back to our 2020 tab. We had a great year then as well. I think we made about 160% last year. Hoping we could, get near that again this year. That would be phenomenal. But as it stands, we're about 5 months into the year. We're just under 30% return. And hopefully this move into these more leveraged plays with greater downside protection can help us. So getting off the topic of Macy's and maybe moving forward a little bit with this concept of using the leverage, let's talk a little bit about the Zillow play that we had set up. So all of their earnings are gone. We don't have to worry about that. They had those a couple of weeks ago, and their earnings were good, which is why I'm even more confident in this play that we have right here. There's great support, as you can see right here, at about 105. Our favorite little indicator, RSI, went blue, which means it's entirely oversold, and that happened at the 117, happened at the 113, and then at the 105 level down here. And as we can see, this looks pretty similar to when it bottomed out back at the beginning of March. Looks pretty similar to when it bottomed out at the end of March. So I'm hoping we could see a little bit of recovery back up to the 120 plus level. And until it gets back up there, I'm perfectly happy to keep selling puts. I think this is a great company. Made some great progress on their earnings, showed a lot of good growth. I think they're going to start taking over the more digital real estate world. But that's kind of besides the point. Getting back to the topic of the discussion that we had on hand with using that leverage, is another one that provides some great opportunity for leverage. As you can see, we've thrown the 105 strike puts up for this next week. So typically, if we wanted to sell a 105 strike put, it would take $10,500 for us to sell that. And again, that's an R of 1.14%, which is kind of whatever, not going to excite anyone pulling 1.14% a week. But when we use that return on capital, we use that leverage to generate a better return on capital. If we want to sell one of these, we could make $111 per $1,500 that we put down, which is a much better value proposition right there. And what I think is great about this, because we know that for it to go down to, and our break-even price on this is like 103.80 if we sell this for $120, it would have to go down about 7% this week, which, not saying it can't happen, because believe me, it's come down to about 110 from 208. But as far as our entry point is concerned, I can't believe there's too much further downside from where we're currently at, especially trading at it got up to 112.20 after hours on Friday after the market closed. So I think this cushion down to 105, which has proven to be a good support, selling a put right at that level is a great safe play, because it's one of those things where, hey, we think the market is going to be coming down. So what we can do is be as conservative as possible. Typically, we'd sell something like 110, and we did have a couple 110 puts that we've sold that are in play for this upcoming week. But we like the idea of getting even more conservative, jumping down to this 105 level, a 7.69% return on your capital right there. And now you put yourself in a position where you could still make an awesome weekly return and absorb a 7-8% drop in the stock. And again, what I keep alluding to, I feel like never quite finished the thought on, is the fact that if the market keeps going down the way that it had, this past week we saw, let me pull up SPY to further contextualize this little rant I'm going on. We saw a pretty decent drop here, and I don't see a reason why we can't make it back down below 400 at some point. We're kind of due for a decent sized pullback, and what we have right here looks almost identical to what we had back in October of last year, and that was quickly recovered as we went from the base to the peak in a week's time, which is absurd for such a large index. And the way it's been behaving over the past year is also crazy. We haven't really had too much of a decent pullback. But if we look at the history of the index, obviously this is the COVID crash right here. But you got to think, after shooting from 218 up to 422, we're due for a little bit bigger of a correction, maybe something like we saw in the back end of 2018 where it went down from 290 to 240, which is about, a 20% haircut on the stock. Could we see something similar like that if we drop 20% from here at SPY? We'll say 20% from the peak of 422 times 0.80. That would put us at 337, which is down here, which I think that might be a little bit extreme for a drop, especially considering some of the policies that the Fed has put into place to kind of keep the market in check. But, again, I don't think getting below 400 is too far out of the question here, especially with some of the crazy, crazy, crazy valuations that we've been seeing. It seems like the air might be starting to come out of the tires of Bitcoin a little bit. And I don't see a reason really why something similar can't happen here. Obviously not a huge drop down to 330 again, like I mentioned, but something back into this 380, 390, 400 range, and that's when I would probably be comfortable going in a little bit more aggressive with the strikes. My game plan for the upcoming week is to be as low stress as possible with some of these strikes we're setting. And even 105 might be a little bit aggressive because we talk all the time about how good a 2 or 3% return is on a week-to-week basis. We could have sold a 95 strike put on Zillow and gotten that 3% return in a week's time. We could have gone even 2 weeks out and sold. Some of these spreads are crazy, so it's not really a great representation of what they're actually offering. But we could have sold a 100 strike put that expired 2 weeks from now that would pull a 12% return, which is a bigger cushion, slightly longer time frame. But, there's something to be said for a cushion like that when you are somewhat fearing a decrease in the market. And especially with the buildup on this one, it traded mostly in the 30 to 60 range over the past 3 years. And I think there is some legitimacy behind the run up here, but I think this is a much more fair range, which is why we got in a little bit. We got our feet right around 140, and unfortunately it dropped on us, as is the case with a lot of these that we play. But, not to keep harping on Zillow too much, since that's a play that we already have set up. But, that's what we're trying to go for with this leverage, not just getting ridiculous returns on a week-to-week basis using this ROC metric as opposed to ROR, thanks to the margin requirements, but using this to get more and more conservative with the strikes. So if the market does keep pulling back, if SPY keeps coming back, and what we think about it getting back near 400 does come true, we can still be in a position where the market has dropped 3, 4, 5%, and we've still made money because our strikes are further below the drop than that. And that is really what we're trying to get out with this leverage, as opposed to just grinding out these enormous week-to-week returns thanks to leverage. I think that's a little bit dangerous. Using it for conservative strikes is the way to go. And I think I probably have said enough about that at this point. So let's get a little bit further into what I want to talk about, moving past this leverage and call skew discussion. Let me Here we go. Going back into our Discord really quickly. One thing I wanted to point out, one of our members, Jeff A, always posts some really interesting scans and analysis. So we're going to take a peek at some of these names. Here we go. List of high dividend yield stocks, and they've been sorted in something called VectorVest from best to worst. Here are his filters. The stocks are going to be over $5, dividend yield over 8%, and average volume over 500K, so that there's at least some liquidity in these stocks. So let's pull this up and see what names we're looking at right here. And it looks like Arbor Realty. We're going to go through, 2, 3, 4 of these, see what we're looking at. ABR is going to be the first one on that list. So let's take a look at ABR. And that one, I'm on 3 year. I was like, good Lord, what's going on lately? Let's look at the 20-day to start off with. Decently tight range. Let's see what the options are looking like on this one, if it wants to show us, if there even are options on this one. I think this may have just been a strictly, there are options. Awesome. Something that's also important here. Let's take a look at the volume to make sure people are actually trading these. There you go. You've got plenty of volume on the 17.5 strike, and that's actually pretty interesting because you can get a 1.89% weekly return selling these for about presumably 30 to 35 cents a pop. putting your break-even price right at that 17.2 range. And you might say, hey, over the past month, it was trading a little bit below that. But the idea with what we're looking at here on this scan is that we've got stocks here that you're definitely okay with owning because they pay a nice dividend. So if you're holding onto those shares, you're going to get some decent cash, because not only will the option premium that you sell lower your basis, every dividend you receive is a dollar for dollar or cent for cent reduction on the basis of the stocks that you've purchased. So what you could do is grab something like that. If you get assigned, you could, I don't know, there doesn't seem to be, maybe part two of this trade might be lacking a little bit, but you could sell something further out, June or July, where you actually get a little bit of premium for the stock that you've put in. But this definitely falls in the category of lower risk, lower stress type plays. Although in the past year, it's run up 3x. I don't really know if, as you can see, they pay the quarterly, it looks like quarterly 30-cent dividend, which is definitely not too bad at all. It looks like that pays a little bit better than the, or almost the same, because you figure 3 months for a, 3 months for a quarter, and you're getting about, 10 cents per quarter, if at all, from these option premiums. So looks like their last one was paid out on March 2nd, 2021. They've announced a, let's see, I don't know if they've announced one. I'm assuming it's probably going to be relatively close to this level right here. But it looks like they paid them on March, paid it November, paid it August, paid it. So you would think at the beginning of June they're going to be paying another one, and that might be the cause for some of the run up here. But, what scares me a bit, obviously, is that it's almost 3x'd in the past calendar year. I don't know if there's enough premium on the downside to help alleviate any of those fears. Let's see if we can at least use some margin privileges here. We know that if we wanted to sell one, it would take $17.50 of cash. This would take $6.90. So you get about 50% maintenance requirement on that one. So in conclusion, but we could keep going back to the list. VEDL is another one that we're going to want to take a look at right here in the high dividend yield stocks. Again, that one kind of scares the shit out of me as well, because it has gone from 461 to 1507 in the past year. But again, let's go through the whole process here. We could take a look at what would give you a 2.56% return in 1 week, which again is phenomenal. We could double check. And I don't know if there's a quicker way. If anyone knows about that, feel free to let me know if there's a quicker way to view the buying power requirements other than just pretending to throw the trade in there and seeing what the buying power effect is. But yeah, 292 on that one. Not too bad. I think 30 divided, that's roughly a 10% return based on that return on capital. You'd be stuck with those shares. But if we look at the dividends, that doesn't look like they've got dividends on here. I think either this must be mistaken or the dividend is newly announced, but can't really say. But let's take a look at a couple more to round off this topic. ENBL, Enable Midstream. ENBL. Let's hope for another stock that yep, almost 3x. It's doubled, gone up to 853 lately, run up a ton. Looks like they just paid out their dividends, so that might be why there was a run up to the dividend payout date. I'm sure there's probably some decent premiums on this, but as you can see, no volume, so probably not a lot of flexibility in how you would execute that trade. So we're going to stay away from that one. Going back to the list, we've got ET, Energy Transfer LP. And this is kind of the basic process we have when we get results from scans and run through things that we see, trying to flesh out what from our scan is good, what is useful, what isn't useful. But I'll keep it moving here. This one's at 10:11. Moment of truth. Drum roll here for the chart. Is it going to be a 3x? Okay. There we go. It's 2x from last November, but where it was a year ago was 785. It's at $10. Looks like maybe an all-time high if we back up a little further. I don't know if it used to be much higher. So what exactly is this company? This is an interesting one we might want to look at. Fundamentals, ET. They own and operate a portfolio of energy assets. They include complementary natural gas, midstream, interstate, and interstate transportation, storage assets. So this might have been impacted by what happened with the oil pipeline on the East Coast over the past week. I think the timeline, if we zoom in here on the 5-day chart, I think the timeline might line up with that for it running 80 cents about when all that the gas shortage happened, because obviously that'd create a premium in gas prices a little bit. But knowing that they've got a bit of a dividend, let's take a look at the options. And there are oh my God, there's a ton of volume on these. Thousands, in fact. We've got, I mean, we could take a look at the options summary statistics here. If we close this, and close this one, we go to option, today's option statistics. We could see that there were 213,000 options on this ticker traded, which is far more liquid than anything that we've looked at tonight. So that's a little bit surprising. A lot of it is on the call side, as you can see right there. 146,000 on the call side compared to 66.4K on the put side, which would potentially suggest some upward pressure on the stock. I don't know if there's any skew at all if we want to further that conversation a little bit, but there doesn't really appear to be. If we want to compare an 8 to like a 12, there's 1 cent on an 8 and 2 cents on a 12. So I don't know how useful of a discussion that would be. But as far as selling options, maybe selling a 10 strike put, getting in at a 980 cost basis for the first week, which is down here. I mean, not terrible. I think there's still a decent chance it goes below that, but you could go a week out. And it looks like these things are offering about 10 cents a week. But one thing we want to be careful about is assuming that just because they're offering 10 cents a week right now means they're going to be offering 10 cents a week all the time. As a lot of you remember on the Nokia trade that we were in on, that wasn't necessarily a fair assumption because the premium on those dried up quickly. So I guess that brings up the question, how do we figure out that if things are, if this is offering what looks like, 20 cents at the money this week, how do we know if that option premium we see today is going to be consistent in the weeks coming? So let's take a look at the charts. And one of the things that we could do is go to studies right here. Quick study, all study. We're going to go to the I's, HI, for implied volatility. And as you can see, this is probably not useful. Let's go to the 180-day. Volatility is decently consistent over the 180-day period. And, premium, it's almost objectively kind of low compared to where it normally trades at. So this is something that would suggest to me that this kind of premium is going to be here to stay. And you count on having that 10 cents of premium on a weekly basis at or around the money to help knock down that price. And again, if this thing drops 20% to $8, you're not going to be able to, keep selling 10 strike calls for 20 cents, but that's 20 cents of premium at the money. But, not a terrible idea, especially for something we always say when we run the strategy. We want to do this on stocks and sell puts on stocks that we're comfortable owning. This has a decent dividend that's paid out roughly. The last one was on February, May, November. It looks like they pay a quarterly dividend of about 15 cents, which again is another thing that would lower your basis. So not a bad one. You could get a decent ROR. And then let's take a look at the hot topic for tonight. If we wanted to sell one of these at a 10 strike, we know that would normally take $1,000 of buying power. However, this only takes $3.92, so the ROC is, a little bit better. ROC, return on capital. There we go. So it would be $17 divided by 392 of collateral. So let me pull this over. $17 divided by 392 of collateral for a 4.3% return with that margin. Now, one thing you will notice if you're trying to quickly scan this ROC column, a lot of the times this will be done on the assumption that they provide you almost like 9 or 10 to 1 leverage as far as buying power versus fully cash secured is concerned. As we can see, that's not the case here because where it would normally take 983, this one takes about a third of that. So our actual return is roughly 4%, not the 9.53% shown here. But, I think ET is one we could throw on the list as well. That's not too bad of an option to get on, and one that we could, let me go back over to the little crappy little list that we were making right here. ET. And that comes straight from the dividends list. We're going to call this one high premium, good BP requirement earnings. And this is high div, decent premium. This might be one you want to throw on your watch list and wait for a little bit better of an entry. Again, one of the other studies that we like to look at is that RSI, and we could pop that on there again by going studies, quick studies, all studies, down to the R. RSI is going to be right at the top right there. And RSI indicates it's definitely overbought right now. Anything above 50 is overbought. Anything above 70 is severely overbought. And that yellow line right there is at 70. You can see when it goes red, that is when it is very, very overbought. But I think, based on how cyclical RSI tends to be, and again, it could level out at 10.15 over the next week. You could say, oh, damn, I wish I, sold the 10 strike put, and RSI would drop back down to the 50-ish level. I typically try to be as conservative as possible with entries, which I think some of you may laugh at because I can pull the trigger pretty quickly on some stuff. But something like this where it's doubled between, October and now, even though we know that when we go further back, we could back up to the year chart, it was further up at some point. I just can't help but think there's going to be a better entry. They just paid the dividend out. People have collected that. So, you might see a little bit of a pullback to the 850 area. And one piece of advice I feel like I give, relatively consistently on some of these streams when we look at stocks like this is, throw it on your watch list. Maybe set a price alert for about 850 and it gets down to there. Then take a look about initiating a position on this one. And that I think is, we're getting about an hour 15. I mean, we might start trying to wrap this one up a little bit. Let me go back through that trade intel tab in our Discord server just to see if we had any more interesting stuff we wanted to take a look at. But again, for those of you that do want to do a little bit more research into this list, I know we got 4 tickers into it, but these are some really good names to look at if you're wanting to further the little mini study that we did on this one. We got some AT&T discussion in here, but it looks like for now that's between call skew, between those high div stocks, and between the idea of using leverage on these. That is about everything we wanted to discuss. I think next week we're going to try to get into actually scanning for some of these better buying power requirement stocks, but that leaves a little bit on my plate because I got to figure out. I'm certain there's pretty much a way to do whatever you want to do on TD Ameritrade, on Thinkorswim. So if there's something I'm thinking that I should be able to do that I don't know how to do, it's more than likely the case that, there's a way to do it. I just don't know, as opposed to, it doesn't have the capability to do that. But looking into scanning for, stocks that provide that kind of leverage and scanning in conjunction with the RSI and the 180-day to find a combination of stocks that are a little bit more stable, stocks that are oversold to indicate a good entry point, and stocks that have a decent combination of premium and margin requirements to let us sell even more conservative strikes moving forward is something that I want to try to be able to scan for because I think that'll present some awesome opportunities. But for now, I think this is where we are going to cut it off for the night, about an hour and 15 in. Appreciate again everyone that joined us on this Sunday night as we hopefully switched it up a little bit for you and got into some more interesting analysis rather than what I feel like can potentially sound like some boring, weekly recaps and then just recapping the same stocks over and over again. Hopefully this is a way to look at a few different tickers, talk about a few different ideas or approaches to scanning or approaches to, collateral and how you allocate that amongst your plays and manage that, especially in the face of potentially risky market conditions, how we want to best position ourselves to still continue to make money if the market continues upwards, but at the same time, protect ourselves if it drops down. But again, thank you guys so much if you tuned in tonight. We'll be back at it maybe sometime again midweek if we've got enough interest in one, but definitely next weekend. Hopefully we will have a profitable week as we try to claw our way back from a couple bad earnings beats on Zillow and Etsy. But, we'll see what we can do. It's only a matter of time. Our break-even price can go down forever, but the stock cannot. So hopefully the idea is one day our break-even price will meet up with the stock on those and we will be good to go. Hopefully Zillow stays flat, Etsy stays flat, and in general, hopefully every single stock we play stays flat and we could eventually retire on an island one day. But that is all we've got for tonight, so thank you so much if you guys tuned in. Thanks to everyone who was active in the chat, both on the Twitch and the YouTube side, and we are going to sign off the way we normally do. saying this has been the Hourglass Trader, where as time passes, we make money. Thank you guys for tuning in. We'll see you on the next one.